Hi traders, welcome to the Ken Tank, where you'll learn how to avoid getting eaten by the sharks on Wall Street. As always, all information is for educational use only. I'm not making advice about what to buy, sell, or hold. Hello traders, and welcome to another episode of the Ken Tank. This is Ken Calhoun. We're going to take a look at 3 different types of strategies for setting stops in this brief video. There's 3 different ways. The most important thing to learn as a trader is how to take stops and how to be comfortable with very small stops and not being stubborn and riding a trade farther than you should. It's a common error that most traders make, and what I want to do is equip you with the tools and the strategies and the techniques for using very tight stops. You know, the 2 important things to do as a trader is, number 1, trade with very small stops, very tight risk management. Number 2, use that with very strong charts. Okay, so we're going to take a look at all 3 of these. One of the first things to cover, though, before we jump into those is the fact that you do need to trade strong charts and not trade all these choppy charts that you may see other people cover, like penny stocks that zigzag up and down are very tough to make it with as a trader. You know, if you're going to trade something inexpensive, I like strong trending instruments like this. Here's CZZ. It went from just under 7 to near 8.5. Or here's PTEN. You could see it ran from 18 to 25. Would have been hard to get stopped out on this type of a chart. And so you want to set the stage for success by trading the strongest possible charts with sustainable trends. You do not want these penny stocks that zigzag and go from $1 to $3 and back down to $1 in the space of a couple of days, because you're just going to lose your money, most likely because it's very tough to time your entries and exits with zigzag pop and drop charts. So strong sustainable trending charts is one of the keys to being successful. The other is using tight stops. And so let's take a look at 3 strategies that I think can really help. Leading our list at number 1. The first one is to use profit and loss based stops, or P&L based stops. And this is one strategy in which I always like to use a maximum dollar cost for my stop. So regardless of what's going on in the chart or the markets, I'm not going to let the trade go against me farther than, X number of dollars. So looking at some real money trade examples, these are both intraday and swings. You can see, if you're in that, once you get in the money in a trade and things are starting to look good for you, you need to manage your exit intelligently. And so the P&L based stop cost may be something really small. Maybe you're going to get out small size, just, $10, $20, $50, $100, $30, whatever it is, so that even if you take a lot of stops, you can still make it for that day's P&L by keeping extremely tight micro stops, is what I call them, because you want to keep the tiniest stops possible. Whenever I talk with traders, whether successful or unsuccessful, the success of a trader is primarily a function of how small their stops are. And the best traders use the tightest stops. The worst traders use huge stops and lose their money. And that's why it's important to use P&L based stops. So if it's against you, just a little bit of money you get out of the trade, and that's really important to experiment with. At least I found in my own experiences to have a maximum pain threshold. So for a swing trade, for me, it might be, say, $200 or so. I don't want a swing trade to go more than a couple $100. For an intraday trade, no more than maybe $80 or $100, something real small. You do not want to have $600 or $800 or $1,000 stops, because it takes a lot of success to subsequent successful trades to bounce back from large stops. And we've probably all done that, myself included. I've taken big stops, and it's smarter to take, say, $10, $50 stops than one $500 stop, because you would have had 10 chances to get the trade right versus just the one. So having a maximum dollar cost for your stops is one strategy that I encourage you to test out and experiment with. Next up, number 2. The second is chart-based stops. And I had an earlier episode, I believe it was 9, you may want to look at that on YouTube, on how to use 2 red candles. But there's visual technical chart patterns you can use to use chart-based stops as well. 2 red candles, either on a daily chart for swings, or 1-minute chart for intraday, or a loss of a 2-day low for swing trades. Let's take a look at a couple of examples. Let's say you're along this chart and now you're wondering, because of Friday's sell-off, where should I get out? Well, I will usually mark out the 2-day low That's the most recent 2 trading days, and then get out, say, 30 to 50 cents under the aggregate 2-day stop. I don't let it go all the way here. Let's say I built a trade. If I was in from, say, 21 and it ran up to 25, I don't want it to come back to 21 and scratch trade it out. I'll sell it, say, 23.50 and lock in a small profit. It can always rebuy up at new highs. So an aggregate loss of 2 days of support is a good reason to exit or vacate the trade. On a daily chart, if you look at the 3-month daily chart, it looks like this. So if you're in a trade on a, say, a cup pattern with a wide range candle breakout and it runs up, you get out on a loss of 2 days support. Okay, so that's one strategy for swing trading. Just use 2 days slightly entered. I don't get out right at the bottom because I may find support there and bounce. So I'll usually do a filter of, say, 30 to 50 cents underneath it in case it finds support and pivots. So I don't want to get stopped out too early, but I don't want to let it go against me far either. For intraday charts, let's take a look at, here's an example of a good runner lately, REN. And this is from the most recent 2 trading days as well. If we take a look at that, you can see on October 13th and 14th, kind of low volume, steady grind. Then it did my favorite pattern, a gap continuation. When you zoom in on that chart, it looks like this. This is Friday morning, and this is the opening bell here at 9:30, and you can see it started to run up. The 2 red candle rule says, you know, once you build the trade long, let's say you get into it anywhere during the breakout, once it loses 2 red candles in a row of support, that's the exit. So here, that would have been 32.40 or so after an entry, maybe 32, 32.10, something like that. So if you do buy during the open range breakout, a good place to exit the trade is if it subsequently, say 10 or 15 minutes later, loses 2 red candles on a 1-minute chart. That's a good professional exit that I've taught traders for many years and published in my industry articles and spoken on at money show events and whatnot. And that's a good sensible, because that tells you, you know, you've got not just 1 minute of sellers, but 2 minutes in a row of sellers, and 3 minutes and we're out, right? It starts to go against us another minute. We get out of the trade before it collapses. So if you do trade during the open for a quick 10 or 15 minute day trade, once you see 2 red candles, a loss of support of that makes sense to exit. And again, I've got more on the 2 red candle exit approach in the Ken Tank episode 9, I believe it is, on the YouTube/Trading Television channel. So that's something to look at as well. If we look at recent strong charts, you'll see, for example, this is a 2 red candle. This would not have been an exit because we didn't get underneath it. So when you look for this pattern on a daily candlestick chart, I like using a 90-day daily candlestick chart. You have to get under the 2-day low. This had 2 red candles, but you wouldn't have gotten out because it didn't subsequently lose that support. It didn't get under 2 red candles, but it is a red flag. So if you see, say if we see another red candle up here next week, right after, say on Monday, or we at any time see 2 red candles and then we lose support, that would be the exit signal for a swing trade. And the final strategy you may want to test is using what I call price-based stops, and that's anywhere from 10 to 40 cents for a day trade or up to $2 for a swing trade. So, you know, if something is, say your initial trade, let's say you buy up at 25.50, you'd set a 23.50 initial stop. So that would be a swing trading stop. You can also use that as a trailing stop strategy as well. For intraday trades, I like using anywhere from, I try and make it as close to break even as possible. So if something runs up, say 10 or 20 cents and then comes back down to the entry, I'll usually just flat the trade. I'll just get it back out of break even because I don't want to have it go against me. So if, you know, good trades are usually right from the start. So if you get into a trade and it runs up for a day trade, say 10 or 20 cents, and then it comes back to your entry, it's a good time to get back out of flat. A good rule that I cover in my Trading the Open live room for active stock day traders is once something goes in the money 20 cents or better, it's a good idea to start taking some profit off the table. So if you're in, say, 400 shares long and it goes up 20 cents, you may want to sell 200 shares to take a quick bite out of the market, and then if it goes back to even, you flat the trade and scratch trade out. If it does keep running up, then you can trail a stop, usually tight. I use 10 to 20 cents most of the time. If it's a higher priced instrument, you know, up at say $50, $60, $70 a share, we may use as large as a 40-cent initial and trailing stop. But most of the time it's 10 to 20 cents or flat, and that's an important strategy for intraday stock trading. And for swing trades, you may use up to $2 or so under the current price to vacate the trade. And that's again for stocks in the $20, $30, $40 a share range. You may want to use something tighter like $1 if it's under $20 a share. So anyway, I hope this helps. It's just 3 different strategies to approach your stops. You have to become proficient at taking small stops. Teaching people to take small stops is the first skill to get at as a trader. It's not technical chart analysis. The most important skill as a trader is to admit you're wrong when you're wrong and make that cost you as little as possible. Like any good business owner, you want to minimize your expenses and maximize your profits. And so as a trader, you owe it to yourself to experiment with different strategies to keep really tight stops. And again, all using paper trading or demo trading while you hammer out a strategy that's relatively consistent. You know, it's easy to get occasional wins and occasional stops by happenstance or by chance. What you want to develop is a consistent approach that works most of the time for you. So just to recap, 3 strategies. One is P&L based, where you may have a maximum dollar cost. Usually tight is best, on your trades. Once it starts to go red, once it starts to go in the sink, at what point do you cry uncle and get out of the trade, right? How many dollars does it go against you? And personally, I like to use no more than $100 or $200 is my goal for exits for dollar cost for my stops. The second strategy is to use chart-based stops, where there's things like that 2 red candle approach for intraday or swing trades, or a loss of 2-day lows for swing trades. And then price-based stops, it may be 10 to 40 cents for an intraday trade, up to a couple dollars for a swing trade. And you can try one or more of these, and I encourage you to experiment with which one works best for you. But again, you want to become proficient in taking small stops is the core skill that you need to get right first before anything else as a trader. It's all about risk management. It's all about, the math is a lot more important than the chart patterns, is a quote that I've published for years, and it's very important. The math and the getting out when the getting's good and it's still tiny and very small, so that you're not in a cycle of small wins and large stops. You want to be in a cycle of small stops and moderate to large wins. And to get there, you need to become proficient in taking tight stops. So I hope this helps. I'll see y'all in my live room at tradingtheopen.com or in my swing trading training at www.swingscans.com. So until next time, make it a great trading week ahead and do well. Best wishes for success. Be sure to join my subscribers at swingscans.com and tradingtheopen.com so you can see these types of alerts in each week's markets.